today's discussion, or for this next discussion, I should say, we're going to be talking about the London breakout. Right? This is one of the strategies that we can use to take advantage of the European market. Now, this strategy, first and foremost, I'm going to put this out there for everyone, and I'm sure there's going to be more traders joining us a little bit later on. So I'm just going to say this now. I will probably have to repeat this several times throughout the course of our discussion, but for the sake of those of you that are here right now, I want you to be aware that the strategy that we're talking about is designed to be traded only during the European session. It's designed to be traded only during the European session. It's designed to be based off of the open of the European session, and you can trade any currency pair that you want. Any currency pair. Right? So let's talk about how to go about setting up for the London breakout. This is the original London breakout strategy as designed by Jose Tormos. All right? Now, this strategy is designed to be used on a 10-minute chart. However, if for some reason your charting software or your platform, whatever platform you've chosen to use, does not have access to a 10-minute time frame, then you can also use a 15-minute if that's what you prefer to use. Okay, 10 or a 15-minute is acceptable. This strategy is going to be based off of the European Open. So right here, right now, I would like to encourage everyone to open up your favorite browser, your favorite search engine, Google, Bing, whatever the case may be, all right, and go ahead and search for your individual time zone in relation to GMT. This is all going to be based off of 8 a.m. 8 a.m. GMT, European time. So London time, 8 a.m. Greenwich Mean Time. Please go ahead and type in 8 a.m. GMT to your time zone, right? Whatever time zone it is that you're in. So for me, personally, I live in Tokyo, Japan. Japan only has one time zone. It's a small little island country. So JST, Japan Standard Time, is what I would search for, right? JST. And if I push enter here, it's going to go ahead and find that 8 a.m. Greenwich Mean Time is 5 p.m. for me here in Japan. All right, so the first time that I'd like for you to take note of is your appropriate or corresponding time in relation to 8 a.m. GMT. The very first time you want to take note of. All right. Bill says, Will, thank you for teaching me the London breakout strategy. I've been trading it for 21 weeks, positive 5,910 pips. Wow. That is fantastic, Bill. Excellent, excellent, excellent. Congratulations. Well done. Well done. Get yourself a beer on me. That is phenomenal. Congratulations, Bill. All right. So once again, traders, the first time that you want to take note of is 8 a.m. GMT, your time in relation to 8 a.m. GMT. The next time that you want to be aware of is 5 p.m. GMT, right? That's the close of the session. So 5 p.m. GMT to JST would be, for me, 2 a.m. my time, right? So wherever you are, make sure that you know what 8 a.m. and 5 p.m. GMT are in relation to your time zone around the world. And please take note of that. If you can confirm that you have those times for me in relation to your time zone in the chat box, I greatly appreciate it. And then we will move on, talk about the London breakout strategy. It's extremely important that you know what time to begin. right? For those of you that have recently had the time change, etc., make sure that you are taking that into account. All right, so let's go ahead, let's move on. We are going to be dealing with the London breakout strategy, and once again, it's based off of the opening, 8 a.m. to 8:10 a.m. GMT, if you're working on a 10-minute chart, of course. If you're working on a 15-minute chart, then it's going to be to 8:15 a.m., all right? So the reasoning behind the strategy is this. The majority of Forex transactions does in fact take place during the European session in London between 8 to 9 a.m. GMT. Now, this particular strategy was designed to try and take advantage of the potential breakout direction for the day from the start of the trading day, right? So if you will, the start of the trading day realistically takes place at 8 a.m. GMT. That's when most of the market movement takes off, from 8 to 9 a.m. That's roughly 3 to 4 a.m. New York time, right? Standard time. When you do the spring forward, it changes a little bit, right? It goes to 2 a.m. Now, even though the Forex is a 24-hour market, ladies and gentlemen, all the currency pairs are moving all of the time, right? All of the currency pairs are moving all of the time. The Forex is a 24-hour market. The volume traded during the Forex is not the same, right? So when the United States is awake and trading, naturally the US dollar is going to move a little bit more aggressively because there's more demand for a country's currency, usually in that country, right? So while everybody's awake and trading, that's usually when you'll see the most movement, although people around the world the rest of the day are also allowed to trade it. That's also when these countries are releasing their fundamental announcements, right, during their own individual business hours. So you're going to have the most movement for an individual country's currency or an individual region's currencies during that session. But the Forex is a 24-hour market. So all the currencies are moving all the time. Most of the movement takes place during the European session because the EU is not composed of a single country or a single currency. The EU is composed of multiple countries, many world banks, many big companies moving vast amounts of money at a time. As a result of that, you have the most volume, the most economic movement taking place during the European session. So the most active session, as a matter of fact, it's known as the active zone, is the European session. The second session in activity is going to be the American session, and the last session in activity is going to be the Tokyo session. It's also known as the dead zone, right? The second half of the U.S., because they all overlap each other. They're 8-hour sessions each, but it's not separated into just U.S. session stop, Asia session stop, European session stop. They kind of overlap each other, right? They're kind of offset, so they all overlap each other. So the second half of the U.S. session and the Asia session is considered the dead zone. The European session and the first half of the U.S. session is considered the active zone. So with this information, guys, once again, the Forex is a 24-hour market, and you can trade any currency pair that you want, but the most movement for any currency pair that you choose is going to take place during the European session. Have we beat this to death enough? Can we move on? All right, perfect. So I'm sure later on I'll also get the question, okay, so what's the best currency pair to trade? And again, you can trade any currency pair you want. As far as what currency pair should you trade, I'm not going to tell you what currency pair to trade. All right? Not going to tell you what currency pair to trade. That's going to be up to you as a trader. As an analyst, I am not your commodities trading advisor. I can't tell you when to get in. I can't tell you when to get out. I can't tell you what to trade. These are decisions that you must make as a trader. However, I can and will equip you with the necessary information that you need to be able to make an educated decision. So the first thing that you want to consider is the average daily trading range for a currency. Okay, the average daily trading range. So if you take a look at your average daily trading ranges, and if you go to forextips.com as well, if I'm not mistaken, you can also take a look at it there. Tips.com. Unless they've moved out as well, I'm not positive, but I'll take a look for you guys. DTR section. Okay, so the DTR section is still up and running. Good. In the DTR section, you can take a look at, and I'll share this link with you all in the chat box. Okay, you can take a look at the average daily trading ranges for the currencies and take a look at which currency pairs may be most attractive to you. An average daily trading range is an average calculated number of how many pips a particular currency pair tends to move during the course of 24 hours. So a larger average daily trading range would be indicative that you have more opportunity to capture more pips. But I don't want anyone to just focus on the average daily trading range. Some of these will have excellent average daily trading, phenomenal daily trading range, 2,400 pips in one day, 2,500 pips in one day, right? And so on and so on. Euro, krona, 391 pips in one day. Fantastic. Who wouldn't want this? But you also have to consider your margin requirement, which is going to be determined by your broker, as well as the spread, also determined by your broker. So you need to investigate this information on your own as far as how much your broker requires for you to have inside your account. That's your margin requirement in order to be able to trade that particular currency pair. And you also want to know how much they're going to charge you, the spread, how much they're going to charge you to be able to place that position. All right, so make sure that you are considering all three of these things, the Holy Trinity, when choosing a currency pair. Once again, the average daily trading range, the margin requirement, and the spread. Any questions on that? Michael, you should be able to just click on the indicator itself, right-click on the indicator itself, or if you have the indicator names visible, if you go to the indicator name, to the right of the indicator name, you should see a few little icons. One of them is going to be like a little alarm clock, and if you click on that, you'll get the window to set an alert on any indicator, stochastic indicator included. All right, we'll be dealing with the stochastic indicators in the next segment when we talk about the modified London breakout. All right, so if you want to remind me then, by all means. In this section, since we're not going to be dealing with the stochastic at all, I'll bring it up in the next segment. It won't let you click on the save. That's weird. That's real weird. All right, we'll take a look at it in the next segment. All right, so when it comes to this particular strategy, again, what we're going to be looking to do is, since most of the market movement occurs in the European session and usually during the very open of the European session, what we're going to look to do is we're going to observe the very opening of the market, the open candle, and we're going to look to straddle it. We don't know what direction the market's going to go as a result of the opening of the market. We don't know who needs what every European session. So this is going to be a straddle type strategy, very similar to the fundamental breakout strategy. Very similar. We would look to set up pending entries in either direction, but straddling the 8 a.m. candle is not a guarantee of being taken in for the true direction of the entire day. It's simply to help you try to take advantage of the London breakout, right? Of the London breakout. So you have to practice proper equity management. And of course, are no 100% guarantees, right? So I want to strongly encourage, I don't want anyone to just take my word on this and just jump into this blindly. I want you to do what Bill has done and first and foremost back test it on currencies of your interest, right? And see how it has done in the past, recently even, and based on that, if you find the confidence, if you feel that it is appropriate for you, then by all means go ahead and use it at your discretion. Okay, but take some time to go back in time, back test it, see how it performed and how it's been doing recently, and that way you can make an educated decision as far as whether or not it's right for you. With respect to your actual entries, this is going to be a one and done situation, right? So if we do get triggered into an entry position and we get stopped out, that's it, right? That's it. That's all it's going to be. If you get triggered into an entry and then you get stopped out, that's as far as we're going to go. We're not going to chase the market. We're not going to reverse the position, go in the opposite direction. This is a one and done. We wait for the next day for the next entry. Any questions on that? Okay, so here's the strategy that we're going to be dealing with. If you want to screenshot this, by all means, feel free. There should be a little screenshot icon, a camera icon on the top right of your GoToWebinar window. And you can screenshot this if you like. We're going to discuss this conceptually first, and then we're going to go ahead, we're going to take a look at it on the charts. Time permitting, we'll do a few examples on a currency pair of your choosing. All right, first come, first serve, a little later on. But first, we're going to discuss the concept so everyone kind of has an idea of what we're going to be looking for, and then we're going to get into the actual practice. Right? The first thing that we're going to do after we identify that 8 a.m. GMT candle, right? 8 a.m. GMT, 8 a.m. London time, London open candle. And we know what our corresponding candle is, right? Everyone here should know what their corresponding candle is to 8 a.m. GMT. And I'm going to help you create something that will also alert you as to when, in a visual way, as to when the appropriate time to get started will be and when to stop. We'll go through that in a moment. But what we're going to do is once that candle has closed, okay, so no earlier than 8:10 a.m. GMT, right? Because the candle opens at 8, and if we're on a 10-minute chart, it's going to close at 8:10. If we're on a 15-minute chart, the candle is going to close at 8:15 a.m. GMT. So no sooner than 8:10 a.m., we're going to go ahead, once the candle does actually close, we can look to set pending entry orders 15 pips above the wick high of that candle and 15 pips below the wick low of that candle. Please note, I am not using the words high and low, just high and low. I'm talking about that specific candle's high and low price, because there will not be two to the left, two to the right at that time. So we're going to be looking for the 8:10 or 8:15 a.m. wick high and wick low, and we're going to go 15 pips above and 15 pips below, meaning your minimum risk to be able to trade this strategy is going to be 31 pips. The smallest the candle can be is 1 pip. So the minimum risk that we're talking about is 31 pips. If that is a large number for you, you need to seriously reconsider your equity management or seriously reconsider the lot size that you're using. Right? If that is coming close to over leveraging your account, we're not doing something correctly. We need to reconsider our equity management. Right? So keep that in mind. Once we have identified these entry targets or these entry points, depending on where the market goes, the expectation is we're going to be triggered in because these are pending entry orders, a pending entry buy stop and a pending entry sell stop. Once we are triggered in, or we're expecting to be triggered in, so we want to be aware of what our risk is, right? Always. We're expecting to be triggered in, and if we get triggered in, the opposite entry order, whatever the opposite of your entry price that got triggered in is, that's going to serve as the stop loss for your entry target. So I have two lines above and below my 8 a.m. GMT candle. If I get triggered into a buy position, then the stop loss for that buy will be what would have been my sell price. If I get triggered into a sell position, though, my stop loss for that entry will be what would have been my buy price. Any questions on that? Willie says, would it not now be 8 a.m. BST now that the UK and Europe clocks have changed to summertime? GMT is 1 hour earlier than BST. The UK market now opens at 8 a.m. BST. Okay, 8 a.m. BST then. 8 a.m. BST. To my knowledge, it's always been GMT, but BST. Greenwich Mean Time is the basis that we use. Right, opening of the market. All right. Once you identify these pending entries, once we identify these pending entries, we're going to look to identify the risk between these 2 points. You want to know what your total risk is because based on your risk, you're going to look to identify your reward. Since this is being traded during the active zone, it is acceptable to go for a 1-to-1 equity management. Okay, since this is being traded during the active zone, it is acceptable to go for a 1-to-1. If you are choosing to go for a 1-to-1 though, traders, make sure that the currency pair that you've been working on, right, when you did your back testing, make sure that the accuracy for that currency pair is above 50%. Actually, I'd rather you look at 65% or more, right? If you are doing 1-to-1 and your equity management or your accuracy is less than 50%, you're looking at not really moving far. Okay, you may want to consider a higher equity management, the more aggressive equity management of 1-to-2. You can apply this to your normal trading as well, traders. Right? If you take a look at your trade history, you run a report, you take a look at your trade history, and out of most of your trades, you know, depending on your win-loss percentage, right, doesn't mean that you cannot still be profitable if you are a low win percentage trader. What you need to do is you need to adjust your equity management. Right? If you are losing more times than you win, but when you win big, and when you lose small, you can still be profitable. If I am a 30% trader, that means that 7 out of every 10 trades that I take, I am losing. But I'm only losing a small amount. And the 3 trades that I win, I'm winning large amounts. Then it's going to take multiple losses to take out one of my wins. That is how you put into effect equity management. Right? Make sure that you are considering this. You're going to have to make that decision for yourself based on your history in trades. Here's an example of, this would be Eastern time, Eastern Standard Time, 3 a.m. candle, right? Which would be 8 a.m. GMT. Once we have that, and the candle closes, right, meaning that it won't change at all. When the candle closes, we go and place the candle, or we place our entries 15 pips above resistance and 15 pips below support. It's 15 and 15. Right? Once we have done that, we're going to measure the distance between both of those lines. Right? The types of pending orders that we're going to be using are entry, buy, and sell stop orders. Very quickly, are there any traders in the room here that do not understand the difference between a pending entry buy and a pending entry buy stop, pending entry sell stop, and a pending entry buy and sell limit? Any traders in the room that don't know what that is? Because if you choose the wrong order, you're going to be looking at the wrong type of trade. Very important to know this information. So if you do not, please indicate that in the chat box. Okay, we've got a few traders mentioning it, right? No shame in that. Let me know. Okay, and I'm going to share this information with you. I've got a write-up and I've got a little image for those of you that are more visual. All right, but I'm going to share these first. Pending orders, I'm going to open that file location. I'm going to pop that in the handouts section. And I'm going to open the image, and then I'm going to just put the write-up in the handout section. You guys can download those. Okay, both of those are in there. Perfect. All right, so let's talk about pending orders really quickly. When it comes to pending orders, the pending orders that we're going to be using are this type: the pending entry buy stop and the pending entry sell stop. Let me preface this by saying that what we're talking about are entry orders. I apologize for the nomenclature. The nomenclature is terrible. We didn't come up with it. It's just market standard. All right. The nomenclature is very confusing, but we're going to make the best of it here on Analyst on Demand. So if you're using any kind of MetaTrader-based platform, you will have to specify what kind of entry you're looking to take. If you're using TradeStation it's smart enough to just know the difference, right? If you put a price, any other price other than the current market price, it'll figure it out, right? But any MetaTrader is just kind of the market standard, and so that's what most traders are using. So the orders that we're talking about, every single one of them, despite the names, are entry orders, right? Every single one of them, despite the names, are entry orders. So the entry buy and sell stop type orders that we're talking about are usually placed when the market is in consolidation, or in this case, when we're expecting a breakout, right? A pending entry buy stop is placed above the current market price, expecting that the market is going to head to that price, trigger me in, and continue in that direction. Same for the entry sell stop. It's placed below the current market price, expecting that the market is going to dip to that price, touch the entry, and continue in that direction. Does that make sense? I'm expecting to look to capture a profit at volume. Any questions on that? Okay. The pending entry buy and sell limit, however, do not operate that way. You're still looking to be taken into a bullish position or a bearish position, as the entry name implies. But it's the limit and the stop type that determine the function of the order, right? So in an entry buy limit, these are usually placed in ABCDs, for example. If I have an AB boundary in place and the market is getting ready to retrace, the bullish ABCD is in place, the market's getting ready for a retracement, then I may choose, since I don't want to sit in front of my computer all day waiting for the market to hit the right price, I may choose to set an entry buy limit at the 5.0, for example, because I've determined that that is, for me, an acceptable amount of risk, placing my stop loss below the A. And what I'm saying to the broker is, look, if the market comes down, retraces, and touches this price, take me in for the buy. Okay, if the market retraces, comes down, and touches that price, I'm okay with the risk. Take me in buying. I'm expecting the market is going to touch that price and turn around and resume going in the general trend direction. Same for the entry sell limit. In a down AB boundary, I may place my pending entry sell limit above the current market price, expecting the market is going to retrace, trigger me into that sell, and then turn around and continue to go in the trend direction, bearish. Right? So these entries are usually placed expecting that the market is going to turn around. The ones that we're talking about, we're expecting that the market is going to hit our price, penetrate, and continue in that direction. Does everyone now understand the difference between the entry buy stop and the entry sell stop, as well as the entry buy limit and the entry sell limit? Perfect. All right, let's continue then, shall we? Let me go ahead and close this. You guys have that image in case you want to download it in the handout section, as well as the write-up on what I just explained by my own composition, so you can kind of take that and keep it as reference if you need it. Let's proceed with the explanation, though. Slideshow from current. Right? So we identified 15 pips above the high of the 8 a.m. GMT candle and 15 pips below the candle. We're going to subtract the difference between these 2 points, or you can just measure it using the ruler tool to identify the total risk, right? Because if the market hits the buy price, I'm going to be triggered into that buy position. And so I would use what would have been the sell entry as the stop loss for that bullish buy position. If the market dips in the direction of the bears and touches this price first, I'm going to be taken into a sell. So I'd use this price as a stop loss order. One way or the other, one is going to serve as an entry, the other one's going to serve as a stop loss. So since that's the case, I'm risking from one to the other. Measure the distance between the two or just subtract, and you'll know what that total risk amount is. When you've identified your risk, you're going to look to identify your limits next based on that risk. So you're going to look to place your limit orders, or your limit targets, if you will, based off of the equity management that you've chosen. It is, I will say that it is absolutely easier, as most of you know, for the market to give you less than for the market to give you more. All right? I'm sure we understand that by now. It's easier for the market to move less pips than for the market to move more pips. So you may choose to go for your conservative equity management 1-to-1. Right? For those of you that are more aggressive traders, or for those of you that have a less accurate portfolio, you may choose to go for the more aggressive target for the 1-to-2. For whatever your risk is, you're looking to capture twice as much. Okay? So that if you take losses, it will take several losses to eclipse one of your wins. By the way, regardless of your equity management, please do not take this to mean that you cannot manage your position. It is absolutely 1000% acceptable to manage your position. As the market moves in your direction, you can cancel and replace your stop loss. You can use a trailing stop loss, which is just an automated cancel and replace, if you feel so inclined. Any questions on this? Gerard says, do you factor the average trading range as well? Gerard, for this, no. No. For that should be something that you've already considered when you've chosen the currency pair. Right? We talked a little bit earlier about when trying to, because you can trade any currency that you want, right? So when making that determination, we talked about taking a look at the average daily trading ranges, right? First and foremost, to figure out which currencies are moving the most, which ones have the highest percentage chance of giving us opportunity. And then the next thing that we do is we take a look at our broker and we find out what the margin requirement is to trade those currencies that we've narrowed it down to, and what the spreads are to be able to trade those currencies. Right? So every time that you look at a different factor, you narrow down the list. You narrow down the list some more to be able to figure out what is most attractive to you as a trader. Make sense? Bill, that's the way to go, in my opinion. Bill says, I like to use the OCO. That's the way to go, in my opinion. If for whatever reason you can't use an OCO, then, and we're going to talk about that, but if for whatever reason you can't use an OCO, then you're kind of stuck with the instant execution. But I think for me, since it's a one and done anyway, we're not going to be looking to chase the market. We're not looking to stop and reverse here. I think OCO is the way to go. It's the most stress-free way to look to set this up. Okay, so in this case, right, for this particular example that was selected for this slideshow, in this case, the market went ahead, post setup, the market went ahead and hit the lower line, which means that it's triggered the entry sell position. At that point in time, if you set up an OCO, and we're going to talk about the setup in a bit, but if you set up the OCO, then whatever you had in the bullish direction will immediately be canceled out. If you set it up as two separate pending orders because you had no other choice or because you don't know how to do the OCO, which you will by the end of this, if you set it up as two pending orders, then you're going to go into your pending entries, and the one that's left over for that currency pair, you're going to close it. Because if you leave it open, you have a stop reverse, right? And we're not looking to do that for this. So if you have an OCO, you've kind of already taken care of that. If you don't have an OCO, then you will go in and manually cancel the other side of that trade, the other pending side of that trade, right? Now, in this case, the sell was triggered, so I'm in this looking to head or sell the market. I'm expecting the market to move down to one of the sell targets depending on my equity management. A short while after that, this did go ahead and hit both the conservative target, and then a little bit after that, it went ahead and hit the aggressive target, right? This is not going to happen every day or quite that violent. Sometimes it may take some more time before it makes its way towards its limit target. But the absolute maximum that we are looking to hold on to a position is until the close of the European market. This is the London breakout strategy. So if we are at the end of the London session, guess what we're doing? Not hanging on to the position. Right? Any questions on this? You will absolutely not hang on to the position past the close of the London market. Okay, so let's take a look. Let's transition over to the charts then. We've got some time here. We've got a few minutes left over. Let's do a little bit of talking about currency pairs, and we can also talk about the OCO, right? Michael, do you have a currency pair? Does anyone have a currency pair, first come, first serve, that they would like to see this a demonstration set up on? Okay, the first request from Michael is for the Euro US. All right, Michael. So let's go ahead. Let's open up charting. New chart. I'm going to open up a Euro US dollar chart. And again, what's the time frame? 10 or 15 minute, right? Perfect. So ideally 10. If I don't have access to the 10, then I'm going to go for the 15 minute. So I click on open, and that's going to give me my chart right here. One of the things that I would like to encourage you all to do is the following. Use the paint at time indicator, right? Hopefully earlier you guys took note of what the corresponding London times are for 8 and 5 p.m. for your time zone, right? Hopefully you took note of those times. You should be aware of the London times for 8 and 5 p.m. in relation to your time zone. If not, please look it up in your favorite search engine, whatever the case may be. Just Google London time, 8 and 5 p.m. to your time. Once you've done that, take those times, and what we're going to do is I'm going to add an indicator here, and I'm going to go over this again in the next segment, but very quickly, I'm going to add, under indicators, there's an indicator called paint at time. Right, so I'm going to go down to that indicator just as soon as I find it. Here it is, paint at time, and I'm going to add 2 of them. 1, 2. 2 of them active. I double clicked on it twice, and it gave me 2 active paint at time indicators. For me, since I am in Japan, the times are, if I'm not mistaken, actually it's 5 p.m., right? 5 p.m. and 2 a.m. for me, since I'm in Japan. So for my first paint at time indicator, I'm going to highlight that, and I'm going to put this at 5 p.m. because that's my time. Actually, no, these charts, excuse me. My charts are set to Eastern time. I apologize. My charts are set to Eastern time, so it would be very, very weird if I put it at 5 p.m. JST. Right? My charts are actually set. I know what time it is over here, but I apologize. My charts are set to Eastern time, so since my charts are set to Eastern time, I'm going to make that change based on Eastern. This is going to be 2 a.m. Eastern time, right? I'm going to make this right here under the draw type. I'm going to make this a vertical line, and I'm going to make that line green so that I know that that's my start time. That's when I can look to start to set up. Okay, and you'll see why I'm meaning this once we add them. All right, and then I'm going to move on to the second paint at time indicator. The second paint at time indicator is going to be for my stop time. Since this is set off Eastern time, I'm going to go ahead and I'm going to put this at 12 p.m. noon Eastern time. All right, and I'm going to leave that line in red, but I am going to make it a vertical line. All right, I'm going to make draw type vertical line. I'm going to leave it in red. That's going to be the stop time. I will not hang on to the, isn't it daylight savings time, George? So in the winter, it goes to 4 a.m. You're absolutely right. Thank you, my friend. I apologize. This is incorrect. All these time zone changes are really messing with me. I apologize. It should be 3 a.m. Eastern time. Apologies. Thank you, George. Thank you, Bill. I appreciate it very, very much. Somebody's got to keep me on my toes. Thank you so much. All right. So should be, I am halfway operating because Japan doesn't change. So I'm halfway between Eastern time and Japan. 3 to 11. Thank you, gentlemen. I appreciate it. Seriously. Okay. Start time, stop time. Start time, stop time. That's what I'm doing. You need to make sure that your times are appropriate and not messed up like mine just now with respect to your time zone. Right? Make sure that they're appropriate with respect to your time zone. Once you've made that and you click on OK, and actually I would encourage you to save this as a custom indicator as well. You can save it as the London breakout. Right? Save it as a custom indicator. I've already done that on my computer, but when you click on Save as Custom Indicator, select to your computer and then label it the London breakout. The only purpose for this is so when you go across to new charts, all you have to do is add the custom indicator instead of doing this for every single chart. What it's going to do when you place it on the chart is it's actually going to mark your start and stop times. Okay, it's going to mark your start and stop times. Right? So if it's 3 a.m. or it's coming up on 3 a.m., I'm going to get this line pop up when that candle pops up, when that candle appears, and I'll know, okay, this is going to be the candle that I'm going to be working with. All right? And if I get triggered into a position, then I'm going to hold that position. I'm going to continue to hang on to that position, but I will not hang on to that position past the red line. All right? Not going to hang on to the position past the red line. Make sense? And I feel like I set the colors backwards. Paint at time 1, 3 a.m. Eastern time, green. Paint at time 1 should be 11 a.m. Eastern time. There we go. Okay, 3 a.m. Eastern time, 11 a.m. I'm not going to hold on to the position past that. If I haven't been limited out, I'm not going to hold on to the position past that. Does that make sense? Okay, so if this is the case, let me get my notebook because I'm going to need it. Bill, you're very welcome. If I'm coming up, and the best days to look to do this are between Tuesday to Thursday. Best days to trade the London session are between Tuesdays to Thursday. But for the sake of this demonstration, I'm going to go ahead and click on this candle. I want to know what the high and the low of this candle are. The high price is 1.0865. 1.0865, and the low price is 1.0858. Okay, so I'm going to place my pending entries 15 pips above and 15 pips below. Above 6.5, we're going up to 80. Okay, 1.0580. 1.0880. And 15 pips below the low of 5.8, we're going to go down to 4.3. 1.0843. Okay, these are my pending entry prices. Any questions on this so far? This is my entry buy stop. Entry sell stop. Okay, Norma, it's 8 hours. So if you're, it's the set, that was my mistake since I had initially set it based off erroneous times. I had it at 12, set for 12 noon, right? It should be 3, if you're Eastern time, it's 3 a.m. Eastern time to 11 a.m. Eastern time. Again, I strongly encourage you just look up whatever time zone you're in because I can't look up everybody's time zones. So this chart, this computer is set up to Eastern time, and the times that I used were 3 a.m. Eastern time to 11 a.m., 8 hours total, right? Make sure that you are looking for the appropriate London time corresponding times for 8 a.m. London time and 5 p.m. London time according to your time zone. Please look that up when you can, right? And those are the times you'll be using. One for stop, one for stop. Start, stop. Okay? So once I have these numbers here, I'm going to measure the risk between these 2 points, right? You can either subtract the numbers or use the ruler tool to measure the distance. I'm looking at a risk of 37 pips. With a 37 pip risk, let's go ahead. We're going to go the conservative way, 1-to-1. I'm going to measure 37 pips to the north. All right, that will put me at price point 1.0918. And 37 pips to the south. $37 pips to the south will put me at price point 1.0907. Nope, 06 it looks like. All right, 06. So we're going to go down here to 06. Okay, so I've got my limits in both directions. My bullish limit, bearish limit. Dorothy, if you search for London time, the computer will figure out whether or not they've done the time change. But yes, they have done the time change. So just search for London time. Okay, so here are my prices. If the market triggers the bullish position, I'm in the bullish position. If the market triggers the bearish position, I'm looking to take the bearish position. Here's the market waving, dips down, right? And if the market doesn't touch either of these, then I'm not trading it, right? This is a trigger for the bullish position. This is a trigger for the bullish position. I'm going to go ahead and tell you right now, if you don't get triggered within the first hour or so, within the first hour to 2 hours, you're going to be looking at a very, very crappy position, right? So if you like, you can take it a step further and set an expiration when you're setting up your ticket. But for the sheer sake of just looking at worst case scenario, this is the trigger here. So this would be a bullish entry position, which means that at the moment that this got triggered back here, right, my entry buy is in. This is my stop loss. And I'm looking to go for the bullish limit. There is no more bearish target, right? Because the OCO would eliminate this. And this would be the position that I'm trading. Does that make sense? I would proceed to hang on to this position until I get limited out or until 11 a.m. Right? If I don't get limited out by 11 a.m., I'm going to close the position. In this case, I would have closed out with a few pips, but not much, right? This is nothing. This is 9 pips in total profit, all right? Monday morning. Most consistent days are going to be between Tuesday to Thursday, but I want everyone to understand how to go about placing this or what the basis behind what we're going to talk about next is. Any questions on this, the base London breakout? Any questions on this? Okay, so we're going to go ahead, we're going to take a short break. When we come back, we're going to be talking about the modified London breakout. The modified London breakout takes this base strategy, and what it does is it also incorporates some of the rationale from the Ultimate Traders package, right? We're going to be building a system together here. Instead of setting up 2 separate entries, 2 pending entries to have one get triggered, we're only going to be looking to set one up in the direction of the larger time frame trend. And I'm going to teach you how to monitor that in real time without having to scramble around looking at the larger time frame for reference. So we're going to talk about that when we return. This has been Will Gomez, FX Showtime. I'll see you at 10:30 p.m. Eastern Time.